In 2026, the IRS is handing most Americans a $15,000 tax deduction. Completely free, no receipts, no accountant, nothing. But here's the catch. If you're a freelancer, a digital nomad, or running an AI startup, taking that easy deduction could cost you thousands. So should you still itemize, or is the standard deduction finally good enough? Let's talk about the law, the math, and the decision that could define your 2026 tax bill. Welcome to Tax and Tech Explained, where we break down the legal side of money, tech, and taxes for freelancers, crypto investors, and modern entrepreneurs. I'm here to help you understand the rules behind your income. Today, we're diving into the 2026 standard deduction. What changed, who benefits, and whether itemizing is still worth it in the new tax landscape. By the end of this video, you'll know exactly which strategy saves you the most money, legally. Let's get into it. First, let's set the stage. The standard deduction is the IRS's default tax break. It's a flat amount you can subtract from your income, no questions asked. For 2026, here's what it looks like. Single filers get $15,000, married filing jointly get $30,000, and head of household get $22,500. These numbers are adjusted annually for inflation, and compared to 2017 before the Tax Cuts and Jobs Act, they've nearly doubled. That's why, since 2018, nearly 90% of Americans now take the standard deduction because it's easier, faster, and for most people, it's bigger than itemizing ever was. But here's the problem. Most people aren't freelancers. If you're self-employed, work remotely, invest in crypto, or run a tech business, your tax situation is more complex because you have home office expenses, equipment costs, software subscriptions, travel deductions, and business losses. And in 2025, the IRS updated guidance around crypto taxation, AI-related business expenses, and state-level freelancer regulations, all of which impact whether itemizing still makes sense, so let's break it down. Itemizing means you manually list every deductible expense instead of taking the standard deduction. Common itemized deductions include state and local taxes or SALT, which are capped at $10,000, mortgage interest, charitable donations, medical expenses over 7.5% of your income, and casualty and theft losses in federally declared disaster areas. The rule is simple. If your itemized deductions add up to more than the standard deduction, you itemize, and if not, you take the standard, but there's a twist for freelancers. Here's what most people don't understand. Business expenses like your home office, software, equipment, and travel are not itemized deductions. They're reported on Schedule C, and you can claim them even if you take the standard deduction. So if you're a freelancer, you get both your business deductions on Schedule C plus the standard deduction or itemized if it's higher. This is huge. Let's say you're a single freelancer earning $100,000 and you have $20,000 in business expenses. Here's what happens. Your taxable income drops to $80,000 after business deductions. Then you subtract the $15,000 standard deduction, and your final taxable income is $65,000. You didn't itemize, you didn't need to, you got both. So for most freelancers, the standard deduction is already a great deal. So when does itemizing still make sense? Here are the scenarios. First, you own expensive real estate. If you're paying $15,000 or more in mortgage interest and property taxes, itemizing might push you over the standard deduction threshold. Second, you live in a high-tax state like California, New York, or New Jersey, states with high income and property taxes where the $10,000 SALT cap hurts, but if you're maxing it out and have mortgage interest and donations, itemizing could win. Third, you made large charitable donations. If you donated $10,000 or more in cash or stock, that can stack with other deductions. Fourth, you had major medical expenses. If you spent over 7.5% of your income on medical care, you can deduct the excess. Here's the key question. Do all your itemized deductions combined exceed $15,000 or $30,000 if married? If yes, itemize. If no, take the standard deduction, and remember your business expenses are separate and you claim those no matter what. Let's hit 5 verified facts for 2025 and 2026. First, the 2026 standard deduction is inflation adjusted because the IRS updates it every year and the $15,000 figure is preliminary with final numbers dropping in late 2025. Second, the SALT cap is still $10,000 and this limit hasn't changed since 2017, making it one of the biggest reasons high earners in expensive states consider itemizing. Third, crypto losses are not itemized deductions because capital losses from crypto are reported on Schedule D and offset capital gains, so they're separate from itemizing. Fourth, self-employed health insurance is an adjustment, not an itemized deduction. So if you're self-employed and pay for your own health insurance, you deduct it on Form 1040 even if you take the standard deduction. Fifth, the IRS is tracking $1,099K income more aggressively in 2025, meaning if you earn over $5,000 on platforms like Venmo, PayPal, or Etsy, you'll get a $1,099K, so make sure your deductions are documented. Here are your 4 actionable takeaways. First, if you're a freelancer, separate business deductions from itemized deductions because business expenses go on Schedule C and you get them regardless of the standard deduction. Second, run the math by adding up your potential itemized deductions, and if they're under $15,000 for singles or $30,000 for married couples, take the standard deduction. Third, track everything because even if you don't itemize, keep records of donations, medical expenses, and business costs since rules change and so might your situation. Fourth, consider state taxes because some states have different rules, and if you're a digital nomad or multi-state earner, consult a CPA. So here's the bottom line. For most freelancers and tech entrepreneurs, the 2026 standard deduction is a solid deal because you get $15,000 off your income with no receipts required plus your business deductions on top. But if you own property, live in a high-tax state, or donate heavily, itemizing might still win. The key is knowing the difference between business expenses and itemized deductions and doing the math. If this helped you understand the law behind your taxes, hit subscribe because smart money needs smart rules. Thanks for watching Tax and Tech Explained, and I'll see you in the next one.